Everybody, Mike DeSepoli, Heritage Financial Advisory. Welcome to Heritage Insider Weekly for Friday, June 26th, 2026. Hope you're having a great week. We are back to update you on the markets and the economy. We got a lot going on this week in the markets. I want to dive a little bit deeper into a couple of individual stock names this week that we've had a lot of questions about, so I think it's very appropriate that we spend a little bit of extra time on them, and we'll also bring you up to speed on all the important news of the week. So let's get right to it. Markets kind of going through a little bit of a late June swoon. We talked about the seasonality of June last week, how the back half of June tends to be a little bit choppy, a little bit volatile. That's really exactly what we've seen play out. All in all, markets handling it pretty well. Decent amount of rotation going on in the markets. NASDAQ and the tech stocks have taken a little bit of a breather, while the Dow Industrials have picked up the slack a little bit. So overall, markets trending a little bit lower here for the week. We're looking at, modest losses across the board. S&P down about 150 points this week, so on or around 2-ish%. So let's cover some individual. First, we'll go through the broader markets together. I also want to talk about the oil markets. We're going to talk a little bit about software stocks, the Magnificent Seven, and then one of the interesting themes that's developing here in the market. So first, let's take a look at the market. A little bit of choppiness here. A little bit of volatility, right? Kicked off by our sell-off 2 weeks ago, just post-Fed meeting, getting a little bit of additional volatility as we move into the end of the second quarter. Nothing wrong here, folks. Nothing to be upset about. We're getting kind of a little bit of a contractionary range that's forming here, just below the all-time highs, but well above our previous all-time highs. So that's good in terms of, from a technical perspective, markets are handling some of the additional volatility the way that you'd want to see. I would expect that we're going to get a little bit more volatility into next week, right? And then you have the 4th of July holiday, which is next Saturday. Markets will be closed for trading next Friday the 3rd, so it'll be a shortened trading week next week. And then I expect things to pick back up in a good fashion as we move into July. So as we look at the market and we look at the index averages, right, which give us a broad view of where things sit right now, we would say that, okay, markets look like they're doing pretty well, right? They're just below the all-time highs, sitting just below our intermediate term target of 8,000. Not sure we're going to get that by June 30th. I think it might be shortly thereafter, but we got to just about 7,700, so pretty close in terms of the first half target. Still some time ahead for us to get there. But when you look at the market and you say, okay, on an average basis, on a broad index basis, it appears to be performing pretty well. How are the sum of the parts doing, right? How are the components of the market under the hood doing? Who's doing the heavy lifting? Who's lagging behind? And should we expect there to be any consistency in that in the second half of the year, or perhaps some change? And one of the very, very interesting themes that has developed here over the last couple months is essentially a narrative where the market is preferring what we would call the vendors over the spenders, right? And so by that, what I mean, what are the vendors? The vendors are the ones that are selling, components, hardware, widgets, if you will, to the AI build-out, right? These are the companies selling the semiconductors, they're selling the memory chips. The market has developed an infatuation with those companies. And at the same time, the market has decided to punish the spenders, okay? The ones that are spending big capex to build out the future of AI, to literally build out the matrix, right? And so the ironic part about this is the vendors and the spenders are directly linked to each other in that the vendors are selling their products to the spenders. And yet one side of the equation is being rewarded and the other side of the equation is being punished. And now when we look at who the spenders are, it's the biggest companies in the market. It's what we call the Magnificent Seven. Companies like Google, companies like Apple, companies like Amazon and Microsoft and the likes. And so, it begs the question to say, okay, if we all agree AI is important and we all agree it's going to be transformative, and clearly the vendors right now are benefiting from this optimism around AI because people are forecasting, individual companies like Micron and Intel are forecasting shortages of their products for years into the future, right? So clearly everybody agrees at this point that AI is legit and it's going to take us to very special places. But yet then why are we punishing the companies that are literally willing to spend the money to build out the future. And herein lies the opportunity. And so what I want to spend a little time on is I got a couple charts first I want to share here. Let me just make this a little bigger. I got a few visual representations of this. So first of all, here is, essentially the vendors versus the spenders, right? The blue line is one of our investments, the SOXX, the Semiconductor Index, which holds many of those companies that are the vendors of AI, right? They're selling the chips, they're selling the hardware, they're selling the components that are being used to build out all this compute. This has done very well this year, up 107% year to date. And then down below in the red line, you have the spenders, right? You have the Magnificent Seven, which is put together into one ETF so you can get a broad composite average of all these companies. And you look at this and you say, wow, negative returns year to date from that group. So a couple things that you could draw from this is, number one, these two generally follow each other pretty closely. And so anytime you have a major dislocation like we are seeing here, it will revert to the mean eventually. Okay? And when that starts to happen, when that catch-up trade starts to happen, it's going to be violent, it's going to be ferocious, and you're going to see the Mag 7 make up a lot of ground in a short period of time and make up for lost time, if you will. That's not to say the stocks are going to fall out of the sky. They are probably due for some consolidation going sideways for a while as the Mag 7 trade catches up. So again, I say this because people want to know, number one, what's going on with a bunch of these Mag 7 companies, right? What they look like hell, and why is that? And I think that right now the market is taking a very skeptical approach to say, you guys are all spending a ton of money. Show us how it's going to turn into profits. We believe it will. That's one of the hills we're willing to die on here, is that all this money being spent by some very brilliant CEOs is not for nothing, and it's certainly going to bear fruit. So that's number one. Here's another view of that. When you look at, essentially a different way to look at this, but the check writers, right? Here's our spenders versus the check receivers. Here's our vendors. And we can see that they follow each other very tightly all of a sudden until something happened in June where these two groups broke in opposite directions, right? Money is flying into the check receivers and it's flying out of the check spenders. Now, this is where the money is made, folks. Finding dislocations like this, it's not to say, oh, you can't buy the green line and make money, but I want to be a buyer of this red line down here. Okay, you're getting the opportunity to own the Magnificent Seven at the cheapest they've been in years while they continually press forward on building out the future. So people seem right now, investors the world over are willing to buy every component of AI. They're willing to buy all the vendors. They want to buy the energy companies. They want to buy everything and everybody except seemingly the companies that will own the future. Okay, AI is going to be owned, run, and operated by the likes of the Mag 7 and Oracle and others. And so I think that that's something that's worth looking at, that's worth talking about. Actually, we'll come back to this in a moment. And so I wanted to look at that. That's number one. And then also the narrative around software. The fact is that in the same vein that the Mag 7, and let me just bring that up on the screen here. This is the Round Hill Magnificent 7 ETF. Okay. Let's just zoom out here a little bit. So for the better part of almost 10 months now, the Mag 7 has been consolidating in a range. Okay, I understand this type of price action is frustrating, right? You're kind of sitting in a rocking chair. We're going nowhere. Other stocks like Micron and the like, SanDisk, are flying high. Why are we not moving with them, right? And I expect the catch-up trade to be brewing. I think that this is bubbling here under the hood. There's a lot of kind of latent energy building up here, and I expect that soon enough here we're going to see the mags break out, and they are such big components of the indexes that this is what's going to propel these indexes to much greater heights later this year. Also, software. Everybody hates software right now. For the life of me, I don't understand that. Let's balance this chart out a little bit. Here's the software index. Again, basically dead money over the course of the last year. Kind of sitting, almost 2 years, the software index has gone nowhere. Again, the concept that software is going to be obsolete in an AI world is one of the most nonsensical things I've ever heard in my career of doing this. All this hardware that people are buying needs to be integrated with software. Okay, so there's huge opportunities that are brewing under the surface. Software there's many companies that are in the software space, but one of the biggest ones that we're looking at, two of them obviously that we own and love, Oracle and Palantir. Both in two different stages of their life cycle. Oracle's been around a long time, Palantir much younger, but both have frustrated investors more so recently. And I think it's important to understand that when the market, kind of gets dislocated from reality, it can stay that way for a little period of time, sometimes longer than most people would hope. But when it gets back on track, it will get back on track in a very fierce way. You can see software, right at the end of May really started to run, and now it's doubled back over on itself. So this is essentially, the index, for lack of a better term, is dry heaving at this point, right? Sellers are getting rinsed out of here. A lot of people are accumulating this quietly under the hood, and we will look back on this sometime from now, 6 months from now, 12 months from now, 2 years from now, and think about how ridiculous it was that investors did not see the forest from the trees in terms of how important software was going to be for the future. So I believe that these investments will bear fruit in a big way. Patience will pay. Quiet accumulation here will pay. And I think that you'll see over time that we're in the right spot. Another one that needs to be spoken about, I'm getting a lot of questions about this one, is Palantir. Okay? A lot of people use price to judge stocks, right? When stock prices are going up, they think a company is great. When stock prices are going down, they think a company is doing terrible. Not always the case, okay? Sometimes businesses are continuing to improve even though their stock price may not be reflective of it. Now, everybody loved Palantir on the way up, and now all of a sudden it's done nothing for the better part of 8 months. It's gone down, obviously, and everybody thinks it's broken. Should we sell it? Is the future behind them? And I'm here to tell you no. I'm here to tell you that part of making a lot of money in stocks is knowing when it's time to hold and when it's time to fold, okay? For those of you that have been with us a long time, we have made a killing on NVIDIA, okay? And that ride that we've been on with that stock for the last 8 or 9 years has not been a straight line up. There's been a lot of violent shakeouts along the way, and I'm going to show you that in a moment for some perspective. There's been a lot of violent shakeouts along the way, okay? And that's just the nature of growth stocks in their earlier phases. At 250 or $270 billion market cap, Palantir is still a baby. It's an infant. It's got so far to go in its future. It's got so much higher to climb. But it's important to understand that when stocks go through parabolic runs, like this stock did, essentially going from $15 to $200, it is totally normal and totally acceptable to see the stock pull back 50%. And come to think of it, Palantir did that just last year, right? Went to 120, went back to 60, and then went to 200. So 200, cut it in half. Where's that? 100. Now, I want to just share NVIDIA for a moment because I think perspective on this one is very important. And NVIDIA's chart goes back much, much, much longer than Palantir, but just for the sake of visualization here, I want you to see every circle that I'm putting on the map here is NVIDIA correcting by 50 to 60% or more. And I think this one here too. Okay. So again, over the last 4,000% of ascent for NVIDIA, you've had 1, 2, 3, 4 pullbacks of 50 to 60%, and you've had probably another 8 that were 20 to 30%. This is how growth stocks behave. It is very normal. As they grow and stretch their wings, sometimes price gets ahead of itself, sometimes price gets behind itself. But I think overall, when we look back in some time, when Palantir is much higher, right? When Palantir is much higher down the line, right? And this looks like nothing but a blip. Yeah, right now it looks a little bit spooky. Whoa, hey, is this the top? I'm here to tell you that Palantir did not top out at 250 or $300 billion market cap. Okay, that is not the stuff of AI bubbles. This thing will be in the trillions long before it's done. So again, I appreciate all the questions about it. We have no concerns about this stock. We think the stock will go much higher. And you can see it's been in a very neat, tidy downtrend, right? You kind of draw a line here, and you could see we had one little attempt to get over the downtrend, but it's been very neat and orderly selling. And now it's starting to find a bounce in a very normal area that you would expect to see stocks bounce. So again, moral of the story, the too long didn't read version, Software will be a big component of the future. Software stocks like Oracle and Palantir will make us a lot of money over the long term. I don't think we're going to have to wait that much longer to see these stocks turn around. I think these are the opportunities that are right in front of investors' faces that many people are ignoring. So let's keep an eye on that and see how that develops over the months ahead. Also, very important, we touch on oil. Just get oil up here for a moment. Oil has now retraced the entire Iran war gains. Okay, we're right back where we started. Up, right, from 70 up to 120, back to 70. Now this will take some time to flow through into the economy. The oil that you're, pumping at the gas pump today was brought in on a ship probably a month ago, and so it's going to take a little time for price elasticity to make its way through the economy. But again, this is the market. Always listen to the market. Don't listen to the news. The market, the oil markets are telling you the war is over. War is over. I get it. There's not a firm deal. They're still negotiating. They're firing off missiles here, there, and everywhere every once in a while. Show of force, etc. Listen to the market. Market is telling you that the war is over. The market has been distracted with other things. This is a tailwind for stocks. When you see oil coming down like this, interest rates will follow, and that will be a good thing for the stocks, as we move into the summer. Also, here's our end of June swoon. Ignore the "you are here" because I had this queued up last week, and I think I might have forgot to share it. We are here on the 26th day, right? So you're essentially at the end of the June swoon. Expect to see a little bit of strength as we close out the quarter, and then we will move, in our opinion, higher into July. Also, just a little more color on oil. This bar graph is the amount of traffic in the Strait of Hormuz. This orange line is the price of oil. So you can see pre-war, ton of traffic going through the strait, then basically drops to zero, right? As oil prices spike, oil prices stayed elevated for a while, and now you can see traffic is starting to pick back up. So again, we still got a ways to go to get back to pre-war traffic in the strait, but price leads, and this is why prices have come all the way back to where they started even before traffic has gotten back up to those pre-war levels. So that's something that's important to watch. AAII Investor Sentiment Survey, pretty steady for bears from 39 to 36. Bulls, a little bit of an uptick. Ironically, just as we had the little June swoon, bulls got a little bit emboldened, right? Always tend to see that. So I think by next week, you'll probably see bulls back in the 30s, bears back in the 40s. We'll get that data next Wednesday. But overall, not a huge change week over week. Not much to look at there. Next week. Let's see. Whoop. We got an error. Let's see if we can get that back. Okay. Next week, we have the home price index on Tuesday. Consumer confidence also on Tuesday. We'll get some manufacturing data on Wednesday. We also have the new Fed chairman giving a speech. This is not a Fed speech. He's just speaking to I don't know, some institute or something of the likes. But nonetheless, markets want to pay attention to what he says. And then we're going to get the employment data, employment rate, and the U.S. jobs report on Thursday. Last month, we got 172,000 jobs. We'll see where that comes in this month. If we see continued strength or stability, at least in the labor market, that will be a good thing overall. But the moral of the story, folks, is markets just kind of going through a little bit of a late June swoon. Nothing that we're too concerned about. We think we have a lot of catalysts in the hopper to push us higher in the months ahead. Look for software to wake up. Look for the Mag 7 to wake up. And when those companies do, I think the upside will be fierce, ferocious, and persistent. So if you have any questions, reach out to us. We're always here to talk to you about anything that matters with your money. Hope you have a great day and a great weekend. And we'll see you next week for Heritage Insider Weekly.